Good afternoon, everyone, and welcome to our webinar on getting the most out of moving averages. This is one of a series of live webcasts offered by TraderPlanet.com through collaboration with our community contributors and other well-known industry speakers. Today is Tuesday, December 1st. Thanks for joining us today. I am Darla Tuttle, and I am your host for today's session with Daryl Jobman, a senior analyst for TraderPlanet.com. Today's webcast takes place at a specific date and time, and therefore any opinions given by our presenter may change without notice at any time. I'm also obligated to convey to you that trading involves substantial risk of loss and therefore may not be suitable for all investors. Past performance is not indicative of future results. This webinar is being recorded and will be archived on TraderPlanet.com, so if you missed something today, you will be able to review it at a later time. You can also find additional previously recorded webinars among our vast free educational resources, such as market commentary, articles, and videos within our site at www.TraderPlanet.com. If you haven't yet joined as a member, you may do so at www.TraderPlanet.com/join. You will also find this web link displayed on your screen. Today's presenter, Daryl Jobman, has been writing about financial markets for more than 35 years, covering all aspects of the trading industry. A decorated Vietnam War veteran, he was a newspaper farm editor and editor of several agricultural publications before becoming an editor of Futures Magazine for more than 15 years. He has written and or edited more than a dozen books on trading, including the Handbook for Technical Analysis. His passion is helping others succeed by learning the do's and don'ts of trading, and through his editorial contributions to TraderPlanet.com, he has really been able to satisfy his passion. We are delighted to have him visit with us today. Please join me in welcoming Daryl Jobman.
Thank you very much, Darla, for that introduction. You can see on the screen that I do have a background, but I don't go quite back as far as waiting data since 1934. Do an excellent job of providing accurate data, so they go back even further than I do, which is a little bit hard to imagine. Well, today we're going to talk a little bit about the markets and how to view the markets, and we're going to focus in this case on moving averages. Obviously, one of the first things a trader likes to do, if he possibly can, is to identify and then catch a trend. In this case, it looks like a nice, clear uptrend in the E-mini. You know, there's been a big debate about whether the E-mini is in a bull market or if it's a bear market rally. A lot of back and forth commentary. Which is it? What's happening? You can make a strong case for either direction. When you're looking at the fundamentals, sometimes traders will sit out and miss a move completely. It's very difficult to trade when you're looking at that far right edge of the chart. On the other hand, when you do look at that move, you can see that going from that low way back in March to the recent high, that was worth almost $22,500 per contract. So you know that's a good move to catch if you possibly can. The question is how to do that. It looks pretty easy sometimes when you're on that. One of the most popular technical indicators for analyzing markets and trading trends is the moving average. One way to trade is to be long when prices are above the moving average and short when the price is below the moving average. Now, that works well during some periods, such as those in the red circles that you see here, when it's comparing price with the actual 10-day simple moving average of the close. But there are some other times when you can see in these blue circled areas here where the prices jump back and forth across that moving average line even when the market is trending. So now the question is, how do you trade those choppy periods without getting wiped out by the whipsaws? The traditional moving average is a good tool to start analysis, but how can you get the most out of these moving averages to improve your trading results? Ways you can identify moving averages. First, we have the simple moving average. You have the weighted moving average, exponential moving average, and then you can also do a little trick with them by displacing the moving average with any one of those. So there are various ways that people have used the moving average to try to analyze markets. Don't want to go into a whole lot of detail about this, but the simple moving average, as you know, is based on one price per period, and that's usually the close. You add up the prices for a set number of periods, divide the sum by the number of periods, and you get a moving average. In this case, it's a 5-period moving average, and the average is 7. When you add a weighted factor to the moving average, you put more weight on the most recent prices, assuming they are the most important for future direction. With 5 prices, the current price is multiplied by 5, yesterday's price by 4, the day before by 3. The least weight is on the price 5 days ago, as you can see on the screen. The sum of prices is divided by the sum of the multipliers to get a weighted moving average of 7.4 compared to 7 that we saw with the simple moving average. Then there's the exponential moving average, similar to the weighted moving average in some ways, but it involves a constant. While the simple and weighted moving averages drop off the oldest price as they move out of the time window, the EMA includes all prices, but with an obvious weighting to the more current price. The calculation to determine the constant is shown on the screen for a 10-day EMA period. I won't go into all the details of that. It looks more complicated than other types of moving averages. Fortunately, these people can smile because the computer does all that calculating now. In the 1970s BC, that is before computers, I don't recall hearing a whole lot of talk about EMAs. Now, moving averages are a good trend following tool, but unfortunately there are some weaknesses that need to be overcome to improve trading performance. First of all, one of the reasons for it is because moving averages are based on past prices. It's always what's happened before. We want to look ahead, not back, but we need to have that back data to help us look ahead. Secondly, moving averages tend to lag the market. They're a lagging indicator. They tend to provide whipsaw signals. You go above the line and then be long, and then suddenly you're out because you have to go short because it's below the line. So you get whipsaw signals. And then to overcome that, sometimes with moving averages, the temptation is to curve fit, to try to get them to look like you want them to look so you can make more money. Doesn't work. One of the pioneers in applying the personal computer to technical analysis to try to overcome some of these shortcomings was Lou Mendelson in the 1980s. Some of the younger members of the audience may assume there always was system testing, there always was analytical software computation, or software to do the computations and analyze markets. But if you are an older trader, you may remember the TRS-80, the Compact, the first Apples, then maybe even the introduction of the IBM PC in the early 1980s. Before that, technical analysis was pretty much limited to large financial institutions with mainframe computers. But the PC and software developers like Lou opened the door to technical analysis to individual traders like you and me. What Lou wanted to do was not necessarily to create the Holy Grail system, which will never exist, but to make the traditional technical indicators like moving averages provide short-term forecasts that would give a trader a slight edge over other traders. You know, a little edge can mean a lot in trading. With markets becoming more global, more interdependent, Lou focused his research efforts on inter-market analysis, realizing the influence that markets have on each other. A move in one market is likely to have a bearing on prices of other markets. He built on this concept to develop Vantage Point intermarket analysis software, which he first introduced in 1991 to analyze one market, bonds, and has since continually enhanced and improved the software to provide short-term forecasts for more than 600 markets, including futures, forex, stocks, ETFs, just about any market that an active trader is going to want to trade. So what is the difference about the Vantage Point approach to moving averages? Well, first of all, as I mentioned, we have to look at the source of the data. It's based on inter-market analysis. A neural network process determines the 25 markets that have the most influence on a target market. With the S&P 500 E-mini, the markets with the most influence are most likely other stocks or stock indexes, as you see on the list at the right here, and that's what you might expect in a market like the E-mini. Let's divert our attention just a second to the corn market. This market is influenced by, believe it or not, by